Hey everyone, I have a very, very exciting show for you today. We're going to do something a little bit different. First and foremost, we are kicking off another weekly series with a very experienced um, resource, actually someone with the highest viewership on this channel. Let's actually welcome him first, and then we'll get into the show in a minute. Well, Jonathan Twomley, how you doing, sir?
Hey, how are you, Michael? Great to be back.
I'm doing very well. I got to tell you, your interview, which I think is 4 or 5 months ago now, about a syndicator selling his entire portfolio, has one of the highest viewership on my channel. So thank you very much for
Oh, it's awesome. I'm happy to hear that. I had no idea that
that.
that topic would be so interesting to people, but
Yeah.
you know,
Uh,
do
uh,
something different and it stands out, right?
Exactly. Being different. And frankly, I think it's calling your shot. I think that's what people kind of really latched onto. Okay, here's a guy clearly successful, hundreds of units, significant profitability, great track record, and you know what? You're like, nope. You sort of pointed to the right field fences and swung, and I think people appreciate that. So that leads us into today's show. You and I both believe that at least a portion, if not a majority, of new syndications, given what we've seen come across our plate, are going to end badly in the next couple of years, but I don't think anybody's really painting the vision of what badly could be. So I thought we would just take a theoretical approach. We're not going to name any names, but we're gonna sort of paint the vision of how the dominoes could fall, because they're going to start to fall, and I think we owe it to people to talk about it. So what do you think about that, Jonathan?
Yeah, I think it's a great topic. And, you know, as you were just doing the intro now, it made me think of a podcast interview that I did on my old podcast a while ago with a guy named Ben Jones, I believe his last name is. And he has a blog called the Housing Bubble Blog,
Oh yeah.
which, if you haven't checked it out, I think you should look at it. It's very, very interesting. And what he does is he aggregates, like, he kind of like pierces through all the fluff and hype about real estate and kind of aggregates all of the bad news, on his site from all over the world, not just the US. And he's not talking about multifamily, he's really talking about single family homes, but still, it's a really interesting site to look at. And I really recommend that people look at it. And one of the things that Ben said to me on that podcast, and if you want to go back and listen to the podcast, my old show is still up on iTunes. It's called Real Estate Launchpad. So I'd go back and listen to the interview. But he had said that the defining characteristic in the housing collapse last time around of who went into foreclosure was not, people who were over leveraged or what markets they invested in or any of that kind of stuff or how experienced they were. It was actually when they invested.
Oh
So the
yes.
people who invested at the top were the ones who overpaid, and they were the ones who went into foreclosure. And so I think that's kind of like a moment that we may be looking at again in the multifamily market soon. And because it's, I get into this argument. Some people may know me because I have a very big Facebook group. It's called Multifamily Investment Community. We've got about 8,500 members in there now and growing rapidly. And I get into arguments all the time with people about, uh, you know, is multifamily real estate recession proof or not, right? And there's a lot of, the real estate industry, the realtor industry is very interested in pushing this argument that it's recession resistant. There's a lot of coaches out there who have a financial interest in getting people to continue to buy their programs based on the idea that, like, oh yeah, it's always a good time to get into real estate because it's recession proof. And inevitably, I'll get somebody who will say to me, well, Jonathan, in the last crash, I did fine. All my rentals did fine. And you have to kind of unpack this, right? Because it relates directly to the when you bought question, right? So somebody telling me I did fine in the last recession, that's lots of people did fine in the last recession. But I guarantee you that in almost every case, those are people who bought well before the peak, right? Because they were able to build in a cushion either through rent growth over time before the peak hit,
Yep.
or they bought at a low enough basis that they had a big equity cushion built in that they, they could write it down and write it back up again. Those people were fine. But I'm not talking about those people. I'm not talking about the people who, bought 10 years before the peak, or bought 2 cycles ago,
Right.
or whatever, or even bought like somewhere in the middle of the peak. I mean, the middle of the cycle, right?
Yeah.
I'm talking about the people who have been kind of like encouraged by all the hype to jump in and be a syndicate. Like, I'm going to be a syndicator. I'm going to buy real estate now because I see everybody around me doing it.
Yep.
And those are like usually sort of the lowest information people. They're also the people who have been sitting on the fence for a very long time and watching everybody else making money, and finally now they can't resist anymore and they're jumping in. And those are the people who are most likely to get hurt. And so I push back. Like, I just want people to understand that real estate is not risk-free, right? It is, and it is not easy. And I try, like you, to be like a voice in the wilderness of reality, of like, hey, come on, folks, like, this is serious business. You can get really hurt if you're not careful. And if you're listening to people telling you, oh, real estate's recession-proof, and that is like, don't get what's the word? By the siren song, right? Like, you hear the siren singing. Don't get lulled into complacency by the siren song, because you're going to crash on those rocks, right? So it's that's kind of been my my message, I think, or my mission over the last couple of years, is to just kind of get the message out there, like, hey, look, you got to be cautious, right? Now is the time for caution. Now is the time to really learn what you're doing. I'm not going to say don't invest now. I'm not going to say it's, like, just because I sold doesn't mean you have to sell. Like, that's not my message. I'm not saying like do what I do. What I'm saying is be cautious, learn how to do this correctly, really be conservative. Now is the time to be more conservative than ever. And, don't buy into the hype about this, because that's when you get hurt. So, and I get a lot of pushback on this message, as I'm sure that you do, because people don't want to hear it, because people are all enthusiastic and they don't want to hear that there's bad news. And I think, they're all gung-ho about how much money they're going to make, because they've seen all these people making money. And we could talk about this forever, but I mean, there's a whole sort of psychological path that people go through from the beginning of the cycle to the end, and like, who's getting in when. And it's kind of like, and it doesn't matter if it's real estate or stocks or whatever. Every market's the same. The people who sit on the sidelines the longest and then finally jump in after they've seen everybody else make money are the ones who get slammed. And that's where we are now.
I think that is I've been searching for the similarities to last time, because I started in 2003. I happened to invest in a market which is Fresno, California, which you can go back and look at the numbers, had the highest appreciation of single family homes 2 years in a row from 2003. Appreciation, right? Like, I think it was 2004 and 2005. It might've been 2005 and 2006, but like 30%, right? It was just crazy appreciation. But you are absolutely right. As I wrote about in our book, One Rental at a Time, we sold exchanged, not sold. We exchanged all of our houses because we couldn't buy a 9th house, right? I was a one rental at a time person. All I knew was houses. I didn't even know what multifamily was, right? I thought only billionaires bought multifamilies, but I couldn't buy the 9th house. And then somebody said, hey, what about small multifamilies? I'm like, I'm not rich. I know what those are. And then I found out they were less. I bought a 5-unit building for $223 and I sold my house for $260 something. Wow. And the rents on the 5 units were almost $3,000 and the rents on the house was $1,100.
Nice.
I mean, like I'm a simple person, right? Some is good, more is better. But why did that happen? It's because everybody was jumping in with these teaser loans and the 2 and 28s and the neg AMs. It's the people that got in late. And I tracked because I only had 8. I tracked every home that we sold or exchanged near the peak. All of them went back to foreclosure. All of them. I actually tried to buy every one of them, all 8.
Wow.
I tried to buy 2 of them back, but I was cheap and somebody else got them. But yeah, every one of them went back. And it was because they all were late to the game. They all used the neg AM 2 and 28 loans, and they all went back almost 2 years to the date after they closed. So the first reset, they never made another payment. Because again, a house at 263 that rents for 1,100 is very different than when I bought it at 107 and rented for 1,100. I mean, it's just nuts.
And look, like, people have to understand, like, I get this is the question that when people tell me it's always a great time to invest in real estate, the question that I ask them, which I never really get a satisfactory answer about, is, if 5 years ago the market said, for this asset, right, if you're going to get me to buy this thing, you've got to pay me 8 cents on the dollar, right?
Mm-hmm.
5 years ago.
Yep.
But now I'm willing to only take 4 cents on the dollar for that same asset in the same market, right? Why? Why is it a good deal now? Why would you do that? Especially if you know that long term that trades at 8 cents on the dollar, right? I mean,
or even 6 cents, right? Even if the long-term average is 6 cents. And the only answer is competition, and I want it before the other guy gets it, right? There's a limited supply. There's too much cash in the system. It's just nutty.
It's all about the demand for the asset. So then, right, but not the underlying fundamentals.
No.
So it's about, I mean, so there's another guy that I interviewed on my podcast. You might want to have him on, Charles Hugh Smith. And he doesn't talk about real estate, but he talks about sort of financial bubbles and stuff like that.
Oh, okay.
And kind of like a contrarian thinker. He put a post up the other day about Apple stock.
Oh,
right?
yeah.
And how Apple stock, their earnings have been flat for years, but the stock price has gone parabolic, right?
Yeah, it has.
Right. So unmoored from the fundamentals, and he's saying, the market is just saying, well, it doesn't, fundamentals don't matter anymore. Oh. It just matters what the Fed does. That's all that matters, is what the Fed does. And the real estate market, there's a little bit of that. It's not as liquid a market, so it can't get quite as crazy, but it can get pretty crazy. And what's happening now, it's the same thing. It's like and I've heard people make this argument, all that matters is interest rates. If you're making a spread between the interest rate and the cap rate, then you're fine. That's all that matters. And on a cash flow basis, well, it's kind of sort of true, right? But then you are assuming that the closer you cut that spread, then you are assuming that your rents are going to stay the same, right?
Well, it's the expenses that is going to kill people, because I lived that world. It's even if the rents stay the same, your expenses are going to go up because
either way. Yeah. Yeah. What I meant was either way.
Yes.
Like, it's either your that NOI, that debt coverage ratio that you have baked into your deal.
Yeah.
You think you've baked it in. That's the thing. They think
you've baked it in.
And the thing is, that can change, right? Because if the economy change, and everybody, and this is, if the economy changes, that's going to change. And if we go now back to sort of where we started to, is real estate recession proof or not? That's what those people are betting on. They're making these bets that they're going to be fine no matter what, because some guru, who I'm not going to name, but everybody knows, keeps on yammering on about how real estate is recession-proof, or multifamily is recession-proof.
Yeah, bigger is better,
Bigger is better, and it's recession-proof, and you should overpay for assets because, for some reason.
Well, again, I'll share my actual experience. It dwarfs in comparison to yours or others, but it's mine, and it's the only one I can talk about with certainty. So we went from 8 houses to 80 units, right? We did 1031 exchanges. So we got out of houses, right? Like the last one we exchanged was like the month of the peak. So great timing, lucky us, blah, blah, blah. But now the recession comes, and now we have 80 units, right? So what happens? So first off, we do have quote unquote record occupancy, which a lot of people like to talk about, right? Rentals go up, people will stay there, rents will get stronger, all true. But my effective occupancy was rough.
I could kiss you right now for saying that.
Yeah. For 2.5 years, my effective occupancy was negative cash flow. I had to carry my buildings for 2.5 years. Now, not a lot, but enough to pay attention for 2.5 years.
Yeah. And this is something that, look, I've experienced rough times with economic vacancy in a good economy, right?
Mm-hmm.
Where you've got, for whatever reason, you've got the wrong tenant mix in there, and the tenant quality is bad,
Yep.
even though the economy is good, and you have 99% occupancy, but people aren't paying their freaking rent.
Exactly.
Right? And maybe it's because the economy is good, because they're like, oh, I'm going to go buy a new truck now.
Yeah.
Right. And so now they're making the truck payment. And frankly, like in some of the places where I invest, which are, smaller cities, like the suburban areas of smaller cities, if you don't have a truck, you don't work. Yep. Right. So they're going to default on their rent before they default on that truck payment. Right. Mm-hmm. And you're like, they're going to figure it out. They'll like make something happen for rent, but like they're going to pay that truck payment. Right. So, so you may have like your occupancy looks great and the rents are rising because people will pay whatever they have to pay to find a place to live, but they're not actually paying the rent, and because they've got all this other debt. Yep. Right. They've got all these. They're probably not that great with money anyway. And
paycheck to paycheck. Yeah.
Paycheck to paycheck. Right. And we know that the average American can't afford a $400 unexpected expense.
So sad.
Right. Yep. It's sad, but I mean, this is the reality. So a lot of investors are not taking this into account. Yep. Right. So they're just looking at like occupancy is going to be high, but what's going to happen in a recession is that people are going to stop paying rent if they lose their jobs or if their hours get cut. Like they don't even have to lose their job. Yeah. Their hours get cut. Right. Now they don't have, they've got even less cushion. They've got no savings. Right. And but you're not going to evict them. Why? Because they're still paying the utilities, or they're still living in the apartment. It's not vacant. It's not like getting moldy, right? It's not like deteriorating because nobody's living there, right? So you still want those people there, right? In some cases, you might not evict them just because, and then the evictions cost money themselves, right? And so you may be in a situation where you start letting people ride in the apartment because it's actually more expensive to have it vacant than it is to have them in there for free. Yeah. So your occupancy might not suffer at all, but your economic vacancy is going to rise a lot. And if you cut that, that bread too thin, right? You cut that slice of ham too thin between, what you owe the bank and what you're bringing in, then you're looking at foreclosure yourself.
This is exactly where I wanted to get to, because this is the first domino to fall that people aren't talking about, is when you're calling it economic vacancy.
Vacancy.
Yeah. I forgot what I called it. Effective occupancy, whatever. It's the same thing. It's people in there not paying.
Exactly.
I think that's the first domino. In every deal I've seen come across my plate the last 12 to 15 months, they're just ludicrous assumptions. It's like they've never operated in a down economy. And oh, by the way, many of them haven't, right? We haven't had a down economy for 10 years, right? So this is going to be the first domino to fall. So, okay. Let's say the economy sometime in the next 3 years has a recession. Unemployment goes from 3.5 to 6. Oh my God, right. 6.
6 is to be considered good.
Yeah, exactly.
That was a good economy.
Exactly my point. Yeah, it's like it's only 6, right? So that first domino falls. You have, depending on where you are, somewhere between 5 and 15% drop in people paying rent. Yeah, and suddenly it's so what happens first? My guess, right? You're the syndicator, but my guess is your preferred return goes out the window immediately. Bing, getting 0%.
Well, the first thing that goes out the window is your management fees.
Okay. Let's talk about that. Okay.
Your asset management fees are the first thing to go, because you're going to try to make your preferred return.
Okay.
So you're working for free.
So the GP is working for free.
The GP is working for free.
Okay.
That's the first thing.
Awesome. Okay.
Then you start cutting into the preferred return, right? Okay. So you're paying less than what you owed, and now you're what you're calling getting behind the pref, which means that if you have your document structured the way that most people do, which is where you have a preferred return that's cumulative, which means if you're not paying it, it's adding up, right? You're getting behind the pref, which means that now, depending on how you've structured your deal, either it's getting kicked to the end of the deal or it's running now, which means that, say, like you have an 8 pref and you pay 6 this year, it means that next year you got to pay 10 before you participate, right?
Okay, all right.
Or you can kick it to the end, which means it's coming out of your back end of the deal, right?
Yep.
Either way, it's coming out of, you're getting further and further into a hole once you get behind that pref, right? And
the GP.
You, the GP.
Okay.
Yeah. So personally, so it means that like the longer this runs on, the less and less incentive you have to work hard on this deal, because you're working for free, and now your future benefits are being eroded, right?
So I like this. Okay, good.
So your investors are now really not in a good place. Of course, they don't really understand that this is going on necessarily, right?
Yeah.
But so you have to be a very, very conscientious person to continue to be spending time trying to get this asset in shape when you're just watching, not only are you not getting paid now, but you were watching your future payments get smaller and smaller and smaller, and possibly become non-existent if you get far enough behind the pref, because you could potentially never be able to dig yourself out. And let's add some more misery to this. Let's just say that that when you go to refinance, you get a 5 or 7 year debt window.
Yep.
And you have to go to refinance, and cap rates have changed because they will in a recession. Now the bank is going to value your property lower. They're going to give you fewer proceeds, and your interest as the GP may be wiped out entirely. Like you may never ever be able to recover from this, right? And at that point, I think a lot of syndicators are they're going to walk away, right? And and their LPs are going to be, and then their LPs are going to be screwed, and then there's going to be lawsuits, and it's just it's a bad scenario to think about. So.
That is awesome. I never thought about how the GP would lose incentives. They would drop their rate first. Makes total sense. Didn't think about that. And then how the return will either be cumulative or kicked to the back end. And ultimately at the refi time, because they're all commercial loans, 5-7 years, very common. If they're wiped out, they have no interest. They're like, oh, that sucked. I'll go do something else.
Yeah. And I mean, and look, you could, if you can write it out and come back up, then you might be back in the money at some point, right? Sure. But it really depends. It really depends on, like how fast you can right the ship, how short the recession is, what the timing of your financing, when it comes due. Yeah. It's all about that, because if you have to, it's not like a house with a 30-year mortgage where it doesn't matter. Like, you just don't really have to worry about timing risk with that. Yeah, you got a
3.5% interest. It just doesn't matter. So
well, not only that, but I mean, it doesn't matter what the interest rate is, right? If you've got by the time, if you actually go 30 years on your mortgage, you've built up so much equity over that time that that refinancing is just not an issue. Yeah. But for a commercial property, when the max you're going to get is 10 years, except for there's some funky programs out there that are very rare that you can get, like FHA programs that 4-year. But generally speaking,
average person,
generally speaking, the most you're going to get is 10 years, right? And a lot of people are going to be tempted to go shorter than that because they're going to want a better interest rate or whatever, especially now because they're trying to squeeze every cent out of it, so they want to get a better interest rate, so they're going to go for a shorter term, or you've got all these people doing bridge debt, like 3-year bridge debt, in place of permanent debt, right? Because they're trying to get, they're doing interest only, they're doing all these kinds of things. All these things, people. I'm sorry. When I talk, I have this way of kind of going from one topic to another. And
it's great.
Get off in tangents, but when people are telling me all the time, like, the problem with the last recession was that people over leveraged their properties. So they were taking, 93%. They were doing like 75% permanent debt, and then they were doing another slug of mezz debt on top of it to like get up to like a 90% or even higher leverage on the property. And then, when rents dropped even a little tiny bit, or occupancy dropped a little tiny bit, then they were screwed and they were in foreclosure. And so people are telling me, oh, but that's not happening anymore because the banks are more conservative, so they're not giving higher leverage than 75%. That's true. But the back end way that they're doing this is with interest only. It's the same thing, just a different form.
Yes.
Right. Exactly. So you're not amortizing any of your debt. It's great in the first couple of years, you're getting a little bit of a lower payment, so that you can stabilize the property and whatever. But the fact of the matter is that you're not amortizing your debt. So if you have this issue where cap rates rise and the value of your property goes down, you haven't built any equity cushion at all. Yeah. And now, you're going to be talking about, you're like trying to run around to sell the property in a bad market, or you're asking your investors you've got to make capital calls on them. Exactly. It's a bad economy now too. So you think about what your investors are going through. Yeah. They're going to be skittish. Yeah. So they may actually have some economic consequences that have happened to them because of the recession. Yeah. Or they're just going to be feeling really skittish, and they're going to be like, you know what? I'm just going to write that $25K off that I invested in that deal. I'm not throwing good money after bad on this. And now you're $25K short. So you're looking to your other investors. You're trying to find somebody else who can pick up the slack. And this is what can happen.
Yeah. So what you just went through with all the money and the interest rates and mezzanine and bridge and all that, this is exactly what happened. I saw it firsthand with housing, right? The 2 and 28s I talked about when I 1031 exchanged out of houses to apartments. It was the same kind of craziness, different vocabulary, different terms, but the same nuttiness. And every single one of my buyers lost the property, right? Every single one. When the debt was called, the economy was different. Lending standards had changed, and they couldn't raise the capital. So they lost them. And that's going to happen again. I'm confident it's going to happen again.
Yeah. And like I said, just to kind of bring this back a little bit, this is not going to happen to everybody.
No.
It's not going to happen to people who bought early enough. It's not going to happen to people who really know what they're doing at the top and build in the right kind of, cushions, let's call them.
Sure.
But it is going to happen to a lot of new folks who just are overly optimistic, have never seen a bad economy before, have never seen a bad real estate cycle before, are listening to all the hype, and are also stretching to make deals work. This is another problem, that there's a lot of stretching going on, a lot of really optimistic assumptions that people are making to try to get this up to the 8 pref that their investors require. Yeah. Right. And so you're kind of layering risk on top of risk, and really you should be, if you look at what the big players are doing, institutional players are really sophisticated, large real estate investors are doing. These are people who they're continuing to buy in a lot of cases because they have to, right? They have a mandate, like an insurance company. They can't just hold these funds in cash, right? Or you have these family offices where they're spinning off so much cash from their main business, and they don't want to have it just sitting around in cash. So they have to buy. But what they're doing is, they're not worried about making an 8 pref to a bunch of LPs.
Right.
They're thinking about capital preservation. So they may say, okay, look, I understand a 4 cap is really not great. I'd rather invest it in 8 cap, but that's where the market is right now.
Right.
This money has to be invested in something. So we're going to invest at 4 cap, but we're only going to go in at 50% leverage.
There you go.
Right? Because we want to be conservative.
Because they can.
Because they can, right? Yeah. And so, or 60% leverage. But that's what the institutional players are doing, right? Yeah. But syndicators are not doing that. Syndicators are looking for more leverage or more IO because they're trying to squeeze out every penny of a return. Or the other thing they're doing is, they're going from 70-30 deals, so 70-30 split, to 80-20, 85-15, 90-10, 95-5.
Oh, wow.
Right. And just to try to make those returns. And again, that gets back then to that incentive problem.
Yeah.
You can imagine
it's not there. Yeah.
If you've only got a 5% potential upside as the syndicator, that's going to get eroded real fast. Oh. If things go wrong. So your incentive there are probably not many syndicators who literally walk away, but I mean, they're just not going to invest that much time and effort
Yeah.
in these things.
And again, this goes back to your example. I think I wrote it down. Yeah, Ben Jones's conversation with you about
Mm-hmm.
it's when you buy.
Mm-hmm.
It's if you did a deal in 2019 or if you do one in 2020 as an LP, you're late in the cycle. Let's just call it that. You're late in the cycle. Here's another fear I have. Again, a lot of new syndicators, maybe even some that have been successful the last 5 or 6 years, so they have a quote unquote reputation. Tell me if this is possible, because I have often thought it was, but maybe it's not. I see what I would call a Ponzi scheme, right? Where their new syndications, their preferred returns not hitting. They take capital from pile A and move over to pile B, so their reputation stays intact, so they can do the next deal. Is that theoretically possible?
Well, sure, yeah, it's theoretically possible. I mean, that's essentially right. That's like the Bernie Madoff.
Yeah, it's criminal activity, right?
Yeah, yeah. But I mean, I'm sure that. Well, look, I mean, I can't remember the name of the group, but there was a group that was in the last year or so. They were arrested for doing essentially that, right? And it basically created this big Ponzi scheme.
Mm-hmm.
I mean, look, I'm sure it's theoretically possible if you. And I guess it depends the way that you would do that. I mean, I don't structure my deals this way because I actually don't. I don't ever want to touch investor money personally, ever.
Right.
So the way that I structure my deals is, the funds come into escrow that goes to the seller,
right,
and then the investors are getting their distributions directly from the property operating account.
Got it.
So I send instructions every quarter to the property manager with the list of investors and where the checks go.
Yep.
And they're distributed directly from the operating account. So it never comes to me
right
to make distributions.
Got it.
But if your structure is that it's coming to you and then you're making the distributions yourself, then that sets up the opportunity, let's say, to get creative. But then, I mean, frankly, you should be sending your investors the financial statements every month or every quarter.
Mm-hmm.
So if they're looking at those things and they're seeing a lot of profit on the property, but they're not getting it themselves, then they should be asking questions.
Mm-hmm.
But maybe look at the less opaque, or so the more opaque you are with your operation,
right?
The more opportunity there is to dip into bucket A to pay bucket B.
Yeah, I go back to human behavior. I don't know. Again, I never theorized, never done a syndication, won't ever do a syndication. But it's just human behavior, right? You've had a good run, you've got you've got the return. People, you're out on stage, you're getting patted on the back, and blah blah blah. You think you're a big chief, and then suddenly the economy turns, and suddenly the latest acquisition's not performing well, but the one you got 6 years ago is, and oh, how do I do this? And oh, by the way, I got the next thing in Dallas I want to buy, and I can't get it if my return goes down. And I'm like, oh my God, this is gonna blow up.
I mean, I don't know. It's possible. I don't.
But not likely. That's a good thing. That's not likely. That's okay. I
don't think it's like a super likely scenario, but it's certainly like within the realm of possibility that it could happen, right?
Yeah.
And look, when things turn bad, then we'll see what's really going on.
That's when your character shows up. Yeah, for sure.
Yeah, and it's just like one of my favorite Warren Buffett, maxims is when the tide goes out, you see who's been skinny dipping, right?
Yeah, I mean, exactly.
We'll definitely see it, and it happens in every cycle. Like, people look good when it's going up, and then it's easy to make money in a rising market, and then when it stops, then
it's different. Yeah.
It's different.
Well, let's switch gears now into how you're helping people. You have Multifamily Launchpad. I want to talk about what it is, why it's a particular passion of yours. Why don't we start there, and we'll dig in a little more.
Yeah. So Multifamily Launchpad is a coaching platform that really I started thinking about it almost as soon as I got into the business. And the reason was that I was really dissatisfied with the information products that I saw out in the market. And both in terms of the content and in terms of the price. And I had my first partner had learned from a well-known syndicator coach how to do the deals, and she was like in the top level, the top level of membership, and so she gave me the materials to review, and I found, on the one hand, I was like, oh, I was expecting this to be completely scammy, and it's not. This is very straightforward. So that was good. But on the other hand, so it was just, it's like, here's how you do it, and blah, blah, blah. But once I got into the business, though, I realized how much was missing from those materials, right? Just so many things that I got blindsided by, that were just because the discussion was too high level. And I think that's the way that these things were structured. It was like, it was meant that the thing that you paid $2,000 for was like a general overview. And then they wanted you to get into some higher level mastermind where you talk about like the real issues as they came up. And I just thought, this is like kind of ridiculous. Like, I don't, like, why are you holding back on information from people? And why are you making it so expensive? Like, just because you can doesn't mean that you should.
Right.
And there's, and even just from sort of like a money-making perspective, a pure sort of like mercenary money-making end of things, I just felt like I'll make more money if I make it available to more people than I would if I say, you got to come, you got to pay me $25,000 to be part of this thing. So, so that was kind of like the genesis of it. I just wanted to really provide better, more complete information right off the bat without making people pay an arm and leg to get it. Make it easy for them if they, look, you could, I also thought it was ridiculous. Like, you're going to pay somebody a minimum of $10,000 or $20,000, and then you get into it. And what if you decide, like, you know what, I don't really want to do this. This is like too much work for me.
Yeah. It's harder than I thought.
It's harder than I thought, which I think is going to happen to a lot of people. Right. Yeah. So but good luck getting your money back. Right. Like, there's no, oh, this is harder than I thought money back
guarantee. Yes.
Right. Right. So, so I thought, like, I just want to make this easy for people. So I set it up as a membership site, right? Where it's just, you pay a monthly fee, you stay for as little as you like or as long as you like. It comes with a whole Facebook community where, like, I was trying to think, like, well, how do I give people actual coaching and advice without doing it one-on-one?
Right.
Which also, just for my personality, like, I hate having the same conversation over and over and over and over again. Right. I just want to say it once and like have everybody hear it and then move on to the next topic. Right?
Go there.
Right? And the funny thing is, I recently actually realized that this is like the difference between the individual one-on-one coaching that costs $25,000 and like what I'm doing is that coach is getting paid $25,000, or you're paying that coach $25,000 to just tell you exactly the same thing he just told the last guy for $25,000, just one at a time.
Exactly.
So like, you're getting paid to get this advice one phone call at a time.
Yep.
Or you could join a program like mine for like a tiny fraction of that cost, and we'll get on a call with the whole group and you can ask me the question and everybody will hear the answer. And I don't have to repeat myself over and over and over again.
That's awesome.
And you guys all get it for a lower price. And then we also have the Facebook group, which is, so like, every day, if you've got questions either about the materials in the course or just in general, then you can answer and like, I'm on Facebook more than I should be. So I'm answering those questions all the time.
You are,
right?
Yeah.
So it's, that's, you haven't seen the inside of the private group, but it's like the big group that you're part of, right? It's just, I try to do some things that are special in that group that I don't do in the free group. So, in addition to the program and answering questions about that, I do a lot more kind of discussing interesting articles that I find that I think people should be reading. Like, sort of, it's a more of a curated, kind of content within the group itself.
Nice.
But really, the point is, you join the group, you get access to several hundred other people who are serious enough to be paying to be members. You get this comprehensive course. It's like 60 plus videos that takes you through, like, literally from like, what's the basic I don't know anything about this field. What's the basic vocabulary I need to know, all the way through how you scale up, into a major operation and everything in between that you'll ever need to know. And if I don't answer it in that program, we can talk about it. And if you want more information, I'll go and make a new video
Exactly.
on that topic. And I do that every month. So, but like I said, I found it almost like I was kind of almost like personally offended by what I saw
I like
out
it.
in the market about what people were being asked to pay. And the other thing that I left out, which is sort of relates to our previous conversation, in order to sell those high ticket programs, you have to tell people that multifamily is always great, and it's always easy, and it's always risk-free, and it's always this, and it's always that. And that message also, I find it really counterproductive.
Yeah.
And to the market in general, I think it's a disservice to the students. So for me, I wanted to also be free to say, like, look, I think this is a bad time to buy.
Yeah.
Right? I think it's a great time to learn. I think it's a great time to get prepared for the next market. But I can't tell you that, like, it's perfectly safe.
Yeah.
Don't do it. Yeah. Risk all your money and your reputation and your family peace and like your relationship with your wife over going and doing a syndication right now. Yeah. But I can't tell that to people. So
yeah, that's the number one reason I wanted to come back to you and try to get you to have these weekly conversations, because we just tell it how we feel. And oh, by the way, something I like about both of us is we are doing what we say, right? You're saying it's not a good time to buy, right? Not buying, right? I'm saying it's the top of the market. I just listed another apartment building for sale, right? Because somebody's going to overpay and I'll move the money into housing. That's fine, right? I get 1031 the other way. It's fine. So,
I mean, I'm still looking, right? But I just don't find stuff. And I still take investors onto my platform, but I have the same conversation with every one of them, which is, look, this is my view of the market. If you're desperate to invest right now, if you have some particular reason why you have to invest, I will introduce you to people that I trust, right? I will introduce you to my friends in this business who I trust, who I know are doing it the right way. Yeah. Right. And if you really need to invest the money right now, but if you don't need to invest the money right now, then, and you want to be ready to get in at the bottom of the next cycle, right? Then sign up and join my platform, and we'll all like rush in together like crazy pigs when the market is ripe for making money. Yeah. And I tell them, and look, I have yet to have a person tell me I don't want to join your platform. Yeah. Because I don't want to wait. Like I have people say, well, I'll do both. I want to invest with somebody else now, but I'll also join your platform. But so I continue to build the investor platform, but I just tell people, like, I don't think now is the greatest time. Yeah. And but I'm still looking, and there are like one-off deals that come up, and
there are unicorns holding 4-leaf clovers out there. They're hard to find. Yeah. I did a 15-unit deal this year. But it was because owner financing, we structured a deal that was good for them, is good for me. I bought it for $400K less than it was worth. They got payments the way they wanted to enjoy the rest of their life. We all win. But unicorns holding 4-leaf clovers are hard. I get really annoyed about everybody claiming they just did another deal. That's what I'm seeing too much of today. I'm like, there are not that many unicorns with 4-leaf clovers in their mouth. It's just frightening.
I don't know if you saw the post in my free Facebook group the other day, but I posted I try to have a little discussion topic every day in the group, and I posted something to the effect of, everybody says that they look at 100 deals to find one to buy. Yeah. Right.
Oh, what about the other 99? Yeah.
Yeah. So how do you know that you bought the one and not one of the 99? Yeah. And I have to say, I was a little bit disappointed in the responses, because the responses essentially most of the responses were to the effect of, well, it may not be a deal for you, but it's a deal for somebody else. And that wasn't what I was, just change the way you look at the deal and it's a good deal. That's not what I was getting at. I was getting at like, how do you know that that you're not the one who's overpaid for that deal, right? Because I think by necessity, right, like it cannot be true that, everybody agrees the market is at an all-time high, right? If that's the case, then it cannot also be true that every single syndicator that you see out there, like trumpeting their deals has gotten a good deal, right? Yeah. Like they
Okay.
can't all be finding unicorns. They can't
No,
all be finding the haystack needle or the 1 in 100. It's
no.
just not possible, right?
Just yeah,
So
yeah.
yeah,
Just because a deal gets done does not
yeah.
mean the deal is good. Those
Yeah.
are not connected.
Listen, and I hear privately from investor friends as who are LPs telling me that they're not getting paid on
Yeah.
deals that they did years ago. Now, I'm not talking about top of the market deals.
Oh,
I'm talking about deals that were done 5 years ago.
oh, it's crumbling already. Oh
They're
my.
not getting paid. But, so it's, listen, folks,
And
just
this
be
is it.
cautious. Be cautious.
And this is with unemployment at 3.5%, interest rates at all-time lows, and this is happening. Oh my goodness.
Well, listen, I mean, well, maybe we should save this as a topic for another conversation, but the economic news that we hear about that's good, you really need to kind of penetrate it because
Well, we
yeah,
will.
it's
Yeah,
yeah,
that will be
there's a lot.
next week's topic.
That'll be next week's topic.
Very, very cool, Jonathan. This has been so much fun. This is exactly what I wanted to talk about, and I appreciate you. And we'll get you on next. What is it? Tuesday? Next
Yeah.
Tuesday at I guess 11 your time, 8 my time. Thank you very much for your time.
Thanks so much, Michael.
Yeah.